The term jumbo loan is exactly that, a larger sized loan. Jumbo loans can be used when you're buying a luxury home, but they can also apply to modest homes in expensive markets. We know the word jumbo can sound intimidating, but it really just applies to loans of a certain value or higher. Still, there are some important differences to keep in mind when comparing jumbo and conforming loans. And we're not just talking about loan size. Conforming loans are backed by government agencies, like Freddie Mac and Fannie Mae. The maximum amount for a conforming loan is $548,250 in most U.S. counties. However, that limit can go as high as $822,375 in high-cost counties. A jumbo loan is any loan above the maximum conforming loan limit for that county, even if it's just $1. Let's say you're in a county where the conforming loan limit is set at $548,250. A jumbo loan is any loan of $548,251 or higher. Now here's where things can get tricky. Because conforming loan limits vary by county, it's possible that a home listed for $650,000 would qualify as a jumbo in one county, but a conventional loan in another. If you are not sure about the limits in your desired area, your loan advisor is at the ready to help. Now, we mentioned loan size wasn't the only difference between jumbo and conforming loans. The credit requirement will be a little higher for a jumbo loan. Underwriters may also look more closely at your outstanding debts, including credit cards, car loans, and mortgage loans, to ensure that you utilize your credit in a responsible way. This means you'll want to show a long history of making your payments on time. Assets are another differentiator. In the land of jumbo loans, cash is king. You'll need cash for your down payment and closing costs, but jumbo loans also require higher reserves. Underwriters like to see a cash reserve of at least 6 months' worth of expenses. This can include funds in a savings, money markets, retirement, or investment accounts. They'll want to make sure you have an emergency fund in case your income dries up. Debt-to-income ratio requirements are a little different for jumbo loans, and they're also less flexible. This ratio is all your monthly debt divided by your monthly income, shown as a percentage. With conforming loans, your debt-to-income ratio can be as high as 50% in some cases. For jumbos, it's typically cut off at 43%. We have programs that allow higher, but as a rule, most cap at 43%. You can add variable income, such as bonuses, stock programs, or commissions to help this ratio, but you'll generally have to show a 2-year history of this sort of income for it to count towards your income. Rates on jumbo loans also tend to be a little higher than their conventional counterparts. If the loan is over $1.5 million, it'll often require a second appraisal. Appraisals on high-value homes are also more expensive, costing as much as $1,200 each. So this is something to consider when calculating your closing costs. Jumbo loans can be a great product when you're in the market for something really special. You'll just want to keep these differences in mind before you jump in head first. Our loan advisors are always here to answer your questions and clarify any jumbo loan requirements. Contact us today to get started.